Deploying your hard-earned capital into traditional monthly or quarterly distribution frameworks is a massive structural bottleneck that systematically slows down your true compounding velocity in 2026. While the vast majority of retail investors patiently wait 30 long days for a single payout cycle to clear, institutional wealth architecture utilizes automated weekly distribution metrics to capture immediate cash velocity. Imagine every single Friday morning, before the US market even opens, your brokerage account automatically clearing a recurring, asset-backed dividend deposit completely on autopilot. This is not about speculative penny stock picking or day trading volatile equities. It is about engineering a highly sophisticated, multi-phase liquidity matrix using institutional-grade income preservation vehicles. By shifting your mindset from legacy monthly cycles to a strategic Friday payout schedule, you systematically eliminate what fund managers call cash drag. Cash drag occurs when your dividend distributions sit idle in an account for weeks before being redeployed. In a weekly configuration, that capital is instantly available to be swept back into the market during volatile intraday drawdowns when high-quality asset prices hit deep, temporary discounts. The mathematical reality behind this framework is undeniable. Increasing your distribution frequency drastically elevates your strategic flexibility and compounding efficiency. When you receive payouts 52 times a year instead of 12, you unlock a profound compounding advantage. Every single dollar returned to you on a Friday can be put back to work immediately, capturing market movements that monthly investors completely miss. We are talking about maximum capital utilization. Let's audit the raw technical configurations, data points, and risk parameters required to construct this automated weekly cash machine. To establish a flawless 52-week recurring payment cycle without causing severe underlying asset degradation or triggering massive, unwanted tax liabilities, we must completely avoid single-company dividend traps. Relying on individual equities like Realty Income or Altria to build a weekly schedule requires buying dozens of different stocks, which introduces massive unsystematic risk to your portfolio. Instead, institutional architecture deploys capital into highly specialized structural tracking funds that handle the internal rebalancing automatically. We utilize advanced weekly distribution instruments like the SoFi Weekly Dividend ETF WKLY and the SoFi Weekly Income ETF TGIF as our foundational portfolio building blocks. These specific instruments are mathematically calibrated to screen large-cap corporate balance sheets on a continuous rolling basis. The algorithms inside these funds filter out companies with high debt-to-equity ratios and strictly select corporations that maintain massive, sustainable cash flow parameters. This guarantees that the core basket of stocks backing your investment is fundamentally sound. These funds capture short-interval interest income and premium cash flows to distribute payouts every single Friday like clockwork. Furthermore, to safely maximize our overall blended portfolio yield without expanding our structural downside risk, we do not just buy and hold these funds blindly. We integrate these core weekly vehicles with defensive covered call premium layers and short-duration treasury tracking systems. By adjusting our total capital weightings to a strict 40-40-20 ratio, 40% in core weekly equity income, 40% in premium options overlay syndicates, and 20% in liquid short-term capital protection trusts, we build an unbreakable fortress. This specific distribution ensures that even during periods of intense secular bear markets or aggressive interest rate corrections, your weekly liquidity remains completely unaffected. In fact, high volatility environments automatically pump the underlying options premiums inside covered call engines, directly scaling your Friday cash collections when you actually need capital preservation the most. You are effectively converting macro market turbulence into consistent, predictable weekly capital. Let's break down the exact mathematical blueprint required to scale this weekly portfolio to a level where it can replace traditional fixed income instruments. To generate a meaningful allocation stream, you must understand the relationship between net asset value preservation and distribution yield behavior. Specialized weekly funds operate on an accelerated distribution calendar, meaning their net asset value fluctuates differently compared to traditional index funds like VO or VTI. Because these funds are constantly distributing cash out of the fund's total assets every 7 days, their capital appreciation curve looks flatter over a multi-year horizon. This is a critical design trade-off that retail investors often fail to calculate. You are prioritizing immediate, high-frequency cash flow over long-term and realized capital gains. To offset this flatter appreciation curve, our 40-40-20 weighting strategy introduces an options overlay layer that thrives specifically when equity growth stalls. When the broader markets trend sideways or experience minor corrections, the implied volatility spikes. This spike inflates the value of the call options written by institutional managers, allowing the fund to distribute a significantly higher payout rate to its investors. Conversely, during an aggressive bull market run, your upside will be naturally capped because those written call options will be exercised. This is why the final 20% allocation into short-term liquid treasury shields is vital. It provides a dry powder reserve. When the market experiences a major liquidation event and weekly equity funds drop in price, you draw down from your 20% treasury reserve to buy more shares of the weekly dividend funds at historical lows. This mechanical rebalancing process artificially forces you to buy low and lock in a permanently higher yield on cost. By managing your cash injections through this strict mathematical filter, you ensure the portfolio never runs out of operational momentum, regardless of the macroeconomic climate. Before executing this strategic framework inside your life brokerage account, we must establish a hard operational rule regarding reinvestment metrics. The ultimate velocity multiplier of a weekly payout design is entirely lost if you let your Friday distributions sit as stagnant cash balances. To unlock the true power of this system, you must execute an automated fractional share accumulation protocol. Instead of extracting the Friday distributions to spend them, your brokerage routing should be configured to automatically sweep those incoming funds back into the core underlying tracking engines within 24 hours of receipt. This continuous, ultra-rapid compounding sequence compresses the traditional timeline required to expand your principal wealth footprint. You are compounding your wealth 52 times a year, creating a compounding wheel that spins 4 times faster than a standard monthly system. Institutional disclaimer: please note that all data, fund tickers, and structural models presented inside this briefing are strictly engineered for comprehensive educational, analytical, and mathematical demonstration purposes only. Past performance metrics across these short-interval income trusts do not guarantee future distribution consistency or payout safety. Options overlay matrices and covered call strategies carry natural capital appreciation caps during aggressive market expansions, and all investments carry inherent market risks. Consult a certified financial representative and assess your personal tax bracket liabilities before executing heavy asset allocations. If you are ready to completely break away from traditional legacy banking traps, stop waiting 30 days for your returns, and start engineering high-velocity financial frameworks. Drop a comment right now with your personal, weekly cash flow target for 2026. Hit that subscribe button immediately to lock in our upcoming institutional data models. Stay disciplined, protect your principal capital, and always track the data.